Hi, I'm Patu from freefincal. Let's talk about whether gold is a hedge against inflation. Now, many people keep saying this, and very few provide any kind of data. And those who do provide data actually appreciate that gold is not really much of a hedge against inflation, at least not for realistic normal portfolios over 10 years, 15 years, 20 years, or even 30, 40 years. So what does this mean? Hedge against inflation means, excuse me, inflation means that the the gold return either over the long term or over the short term should be above that of inflation. Now, does this actually work out to be the case? These are 15-year rolling returns, and the brown is the gold INR, the white is the Nifty 500 total returns, the Sensex price return excluding dividends is the light blue, and the gilt return is shown in this I don't know what color is this, some kind of burgundy kind of color. Right now, if you see this, now obviously I don't have data over the same duration for Nifty total returns, Nifty 500 total returns, and the IBEX, but this is what we have, and we'll make do with it. If you look at the in the 90s and in the 2000s up to maybe even up to 2010, gold return was 15-year returns for gold INR were below 10%. Now, in this period, without taking any kind of risk, I could have got a fixed income return of 8 to 10% in different places, from small saving, PPF, fixed deposits, whatever, etc. And that means that the kind of inflation that persisted in the country was very high during this period. And so clearly, for 20 years, the 15-year return was below par, and it was not really a hedge against any kind of inflation. And you can see that equity returns, even the price return, was reasonably high, typically at all point. I mean, most of the time. There are some instances when it was down, but that's to be expected from anything linked to the capital market. Now, the gilt returns, if you can see, they're not as high as the gold returns, but they're just a little bit, only a little bit below. And if you look at the gilt returns in the 2010s and later, you can see they were little bit above 10%, and then a little bit below 10%. What is more important is if you consider the risk associated. This is the rolling returns, this is the rolling standard deviation over 15 years. The Sensex price is the green line. Gold, the brown line, is very close to that of Sensex. So it's got a volatility very close to that of equity and significantly higher than that of gilt, which is somewhere here. But for that kind of volatility, which is comparable to equity, the reward is typically lower than that of equity. And that's the problem with gold. It gives you a lot of volatility, but it does not offer you the reward. But if you consider gilts, they have significantly lower volatility, but their returns are only a little bit below that of gold, and that's an amazing solution to beat inflation, especially with a debt mutual fund where the taxation will be lower. I mean, you cannot beat inflation with gilts. At least you can keep pace with it to some extent, as long as you can stomach volatility. So let's get to talk about gilts later, or already we have. But is gold a hedge for inflation? Not really, not consistently. It has not been that has not been the case for at least 20 years in the past, or sorry, 2 decades. Yeah, 2 decades in the past, and that's much of a disappointment. The reason for that is, if you look here, compare the gold INR versus gold USD. The gold USD is in yellow. You can see here that these are 16-year rolling returns. I did that because for twice the sovereign gold bond duration. And you can see here there's a market difference between the gold INR and the gold USD. That is because in the 90s and the 2000s, the currency was playing catch up. It was not, our currency was unstable. It was rapidly losing value, and then only Recently, it has stabilized, and you can see the gold in both currencies are behaving similarly only recently, and at least in the last decade or so. And this is something that has to be kept in mind when we talk about gold returns. Many people forget this because they don't look. So in the long term, it's clearly not a hedge. At least it's not an efficient hedge. That much I would tell you. What's interesting is if you look at the inflation rate and the gold price, and if you compare the rate of inflation with the change in the gold price, if you look at the overall correlation coefficient, it's actually minus 0.08. So that tells you that there's no correlation at all. But you have to look a little bit closer because of the fact that at least until the 2010s, the currency did not stabilize enough for the gold prices to move in tandem. If you take that into account, and if you look at the correlation up to 2000, the correlation is minus 0.017. But if you look at the correlation from 2000 to 2021, the correlation between inflation rate and gold price return is actually 10%. So from minus 0.017, it has jumped all the way to 10%. That's a big jump. That is because only now gold is actually responding like gold INR is actually responding like gold USD. So it's a big jump, but it's still only 10%. Also, some people believe that gold price will increase when the repo rate is increased. Now, if you look at the change in the repo rate versus the gold INR price change, the correlation between the two is a little bit better. It's 19% since 2000. So, but it's only 19%. It's not a guarantee that just because the interest rates will be increased, gold price will also increase. It doesn't work like that because there are too many players in the international gold market for it to actually start responding to local country interest rate changes in a particular country. So that's not true. So even in the short term, gold is really not a hedge for inflation. In the long term or short term, it's not. At best, it's an inefficient hedge. If I must allow myself to be generous, I should say it's an inefficient hedge. And I would strongly recommend against adding a small amount of exposure to gold, 10%, 15%. All these things really don't make any kind of difference over the long-term portfolio. Yes, that gold is a safe haven in terms of fear. When there is a fear in the stock market, people go to gold, but that's only in the short term. If you take consider over a long term, though that kind of movements don't really make a big difference, as we just saw in the 15-year returns. Also, if the currency becomes completely worthless in the case of hyperinflation, then gold becomes a universal currency. Then gold has got a lot of buying power. Its buying power will not get diminished because the currency has gone down. I agree, but then how much gold should you have to buy a couple of idlis on the street when the currency becomes worthless? That's the problem. So it's impractical for us to hoard physical gold when the currency becomes worthless. And at that time, I don't know how much we will be able to pull out from gold ETF, what it will be worth, and so on, or gold bonds or whatever it is, because they are not really linked to physical gold. So it's not practical to hoard physical gold to fight hyperinflation. It is not practical to say I'm going to have a small amount of gold exposure, 15%, 20%, whatever it is, and say I'm going to use that as a hedge against inflation. It just doesn't work like that.